Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
There's a lot that's coming at us.
It's been a busy
summer. You haven't noticed. All right, including lots of surprises, including this morning when it comes to the U.S. economy. U.S. economic growth accelerating by more than forecast in the second quarter, illustrating demand is holding up under the weight of higher borrowing costs. The economy's main growth engine, personal spending, advancing 2.3%, also more than projected.
Meantime, a closely watched measure of underlying inflation rose 2.9%. It eased from the first quarter, but it is still above estimates. That's according to the Bureau of Economic Analysis and the report this morning. So let's get to it, Carol. The latest on the economy and how it's reflected in the U.S. rates market and what it means for Fed policy.
All right, back with us are two Michaels, Bloomberg News International Economics and Policy Correspondent. In fact, for the next 20 minutes, it's all Michaels, guys. I'm just going to tell you. Bloomberg News International Economics and Policy Correspondent Michael McKee, along with Bloomberg News rates reporter Michael Mackenzie, both lucky for us in studio. All right, Mike, I was listening to you breaking it down this morning. This was a strong report.
I'm hungry. I want that bowl.
You want the Chipotle Boy Bowl?
Are you a Chipotle Boy Bowl?
It was definitely a stronger report than anticipated, and it was the composition of it was very good for the overall economy because it was basically stronger consumer spending and stronger business spending, and this wasn't one of those where it was inventories and trade that tricked things up. Although trade was a big drag and inventory is a big gain, but they sort of offset each other. So you look at the spending numbers, and consumption was still good. Now, since then, we've had some data that suggests the economy is slowing, but you can see the way the market repriced after the data today that people are thinking the Fed doesn't have as urgent a task in cutting rates.
Well, that's my next question, Michael McKee, is how does it change Jay Powell's move and the Fed's move next week, or lack thereof?
Yeah, it doesn't change it. There was a feeling that they didn't need to cut anyway. They've gone into the blackout period without suggesting that because the markets had done their work for them and started pricing in 3 rate cuts over the next 4 meetings, and that would include September as a start. But since they'd priced ahead, they basically had a rate cut. Now, a lot of that's washed out of the market today and the strength of this, but it hasn't changed the view that we're still going to see a September rate cut and then probably one in November and maybe December as well. So it doesn't really change it a whole lot. The inflation numbers you mentioned, Tim, they were not as good as expected, but they're less important to the Fed because they're quarterly averages, and the PCE inflation numbers we get tomorrow for the month of June will be much more important to them. But the thing about both of the numbers that came out today, the headline and core on a year-over-year basis, is they went below 3%. And so we're getting into the territory where the Fed has said it will cut rates.
Getting ready to bring out the champagne. So Michael Mackenzie, come on in on this. Should we get ready to break out the champagne? How are you seeing it?
Not yet. I think the bond market got pretty excited this week, but it's now back to sort of pricing in on 65 basis points of cuts for this year. So you're sort of looking at 60% odds of a third cut. It's come back a bit from this morning. We had an October Fed funds showing there's a 20% chance of a 50 basis point cut in September. That's now come back to around 10-12%. So that was sort of doing the rounds. I mean, I think if you look at what's happened in the last few days, we kind of got a foretaste of this when we saw a record demand from investors on Tuesday for the 2-year sale. And that told you that people now know that the Fed is in play. It doesn't matter if it's going to be a couple months down the road. You need to start moving from cash and start parking some money in that 2-year around 4.5%.
Because this might be as good as it gets.
This might be as good as it gets.
For a while, yeah.
There's a lot of chatter in the market about how lower income consumers are suffering. We've had a lot of earnings reports where companies have talked about, the consumer isn't happy. We don't have pricing power anymore. You've kind of got Chipotle now saying they're going to go back to giving people bigger orders, which will really make my son and his teenage friends really happy because that's where they go
Bring it
after
on.
school.
Yeah.
So the bond market here is beginning to sniff out a slowdown in the economy and a need for some rate cuts. And in particular, as Mike McKee just said, as inflation's been coming down, that funds rate's been stuck there for the last 12 months. So policy is becoming more and more restrictive, and it is starting to show up. And this is why the bond market feels pretty confident. And you're seeing this because the yield curve is getting closer and closer to no longer being inverted between 2s and 10s. 5s and 30s broke out this week again to new highs since last year. And that's where a lot of asset managers are very happy, because they love owning the 5-year. They don't really want to own the 30-year at this point.
Well, so does this mean, Mike, we escape a recession, and that this soft landing, like, here we are, guys?
Well, it's not a guarantee, but it certainly puts a thumb on the scale of the idea that we have a softer landing and not a recession. We'll have to see how the third quarter numbers develop as we get deeper into it. But when you're looking at GDP of 2.8%, that's almost a full percentage point above what people consider potential. And then you've got inflation going down. Markets obviously are fickle, and tomorrow, if we get good numbers on inflation, they could go down, but maybe there's an upside risk to personal spending given what we've seen today. So they'll try to figure it out, but at this point, you just have to say the Fed is probably going to not do anything next week and then signal a September cut. And when that happens, then the market probably reprices, bonds go up and yields go down because people are starting to think they're coming that way.
Mike McKee, it's interesting because we have gotten a couple prominent voices calling on the Fed to make certain moves. For example, Bill Dudley yesterday said, I changed my mind, the Fed needs to cut rates now. We talked about this yesterday a little bit. And then Mohamed El-Erian out with the Bloomberg opinion piece that says the Fed may be 2 meetings from a policy mistake, urging that they should not delay an interest rate cut beyond September. How should our audience take these?
Well, Bill Dudley was on Bloomberg television today at 8:15, right before the numbers came out, and I wonder what he would have said had he still been on the air, if he'd still think they need to cut next week.
Maybe higher for longer still.
But my good friend Mohammed raises kind of a straw man about 2 meetings, because the Fed doesn't know what it's going to do. It's really taking this meeting by meeting. They're moving towards rate cuts, and there's no reason to think they wouldn't do one at this point in September. So I think the idea that they would skip September is maybe kind of just a rhetorical thing at this point. They haven't given us any reason to think that they would.
I want to go back to Michael Mackenzie, asking Mike about, soft landing. What are you hearing? Because I still think about how long we had that inverted yield curve, and doesn't at some point that kind of smack us in some way? But, I don't know. Do you think we just see this soft landing or what are you hearing from traders?
There's a lot of concern about the sort of lower income consumer. We're still in this K-shaped economy.
Bill Dudley kind of brought that up. Right? Wealthy consumers are okay, but
wealthy consumers are fine. The key point here to watch is the labor market. If unemployment starts to pick up, if layoffs begin to accelerate. I mean, today, the other good part of the data today we saw was jobless claims. Continuing claims has been something that's been on a lot of investors' radars. That came back a bit. So again, but there's a long stretch between the July meeting next week and the September meeting at the Fed. And that's what a lot of people in the bond market are looking at, saying, okay, we're going to get a lot of data into that September meeting. And by then we should have a pretty good idea whether or not the Fed can go 25, but more importantly, do they do another 25 relatively quickly after that? Or if you get a real sign of weakness in labor, does it begin to sort of arouse that 50 basis point cut? And again, it's very unusual for the Fed to start any easing cycle with a 50 basis point cut.
Very, very briefly, the sizable change in labor. What's the number, Michael Mackenzie, to look for? Very briefly, what would scare the Federal Reserve?
Something close to zero or negative. I always remember back in 1992 when the August payrolls were massively negative and the Fed actually cut.
So it has to be that
drastic.
It
has to be very. I mean, it has to be a genuine shock
Yeah.
for the Fed to sort of say, okay, we are behind the curve, and nothing suggests that they are at this point. And what the market is saying is that they're just pricing in that sort of tail risk. And part of that's because there is such a long gap between the July meeting and the September meeting.
It's a long time, those dog days of August or dog days of summer or whatever you call it. Last question to you in terms of the job market, because we have seen increasingly the Fed, Jay Powell in particular, remind us it's a dual mandate. You're talking a lot more about the labor market.
Well, they've been watching the labor market because it has been weakening a little bit. The bad thing about next week is that they don't get the jobs report before the Fed meeting. But if the unemployment rate rises to 4.2%, which is not what's forecast, but if it did, that would trigger the Somme rule, and then that would scare the horses, because then everybody starts to think, well, we're going into recession because it's always said that before. Now, Fed doesn't think this is completely accurate because a lot of it's driven by a rise in the labor force, but Bill Dudley noted that happened in the 70s too, and we still had a recession. So next Friday is going to be a very interesting day too.
It's just all these points, as we said, a lot of stuff keeping us on our toes. Michael McKee, thank you so much. Always appreciate it. Michael McKee, of course, international economics and policy correspondent here at Bloomberg News, and our thanks to Michael Mackenzie, rates reporter at Bloomberg News as well. And I feel like our Michael Palooza continues.
Michael Palooza it is. We now get to the equity play off of this morning's stronger than forecast GDP report. This after yesterday's stock sell-off, which wiped $1 trillion off the NASDAQ 100. Wall Street traders betting that the Fed will be able to engineer a soft landing did spur a rally today in riskier corners of the market, with stocks, Carol, rebounding after a sell-off that jolted markets around the globe.
All right, so let's get to it. Let's bring in Bloomberg Intelligence equity strategist Michael Casper here in studio. So, Michael, we've talked about kind of the equity, certainly the equity reaction we've seen to that better U.S. GDP report. We've hinted on it. Walk us through it, because we're almost a 1/3 of the way through earnings. Are earnings justifying some of the moves that we're seeing in the market? Maybe a slight pullback, but maybe some momentum once again to the upside?
Yeah, certainly in the S&P 500, right? So you've got significantly better than expected earnings results for the S&P 500, so large cap stocks, and that's driving a lot of this rotation, right? So you've had tech leading the way in 2023, and now you've got that kind of seeding some of the growth towards some of the cyclicals, so stuff like energy is coming online, healthcare coming online, a lot of different sectors starting to kind of confirm the rally in EPS, and that's kind of driving a lot of the rotation, at least within large caps.
There are some mega cap tech stocks, though, that have reported in recent days, and it hasn't been so good. Tesla and Alphabet certainly are the ones that I'm thinking of. And then in a totally different area, you had Ford report yesterday, and you're seeing shares just slide today. How do those numbers, how do you think about those numbers in the context of what you just said?
Yeah, I think they were relatively mixed. They were kind of somewhat in line, at least with Google's big report, but
no sort of canary in the coal mine.
Yeah, no, not necessarily a canary in the coal mine. Actually, what I would say is that this rotation feels very healthy within large caps, right? So you've got the tech component and the tech related component trading at pretty high valuations. They peaked around 28, 29 times historically. That's right about where they are right now. And you've got earnings growth for the rest of the index starting to catch up. So it's pretty healthy rotation, I think, in large caps.
Having said that, I got to say, one thing that struck us this morning on our read-in, research, I believe, from your team, from the Bloomberg Intelligence team, about how with almost a third of S&P 500 companies reporting those second quarter results, spotlight increasingly on sales, only 43% of companies have managed to beat revenue expectations, which would be the lowest reading in 5 years, according to BI data. Is the quality... Earnings, we know things can be done. Top line revenue growth, not so much. The number, is the number. Is the quality of the quarterly results, especially when it comes to revenues, coming down?
I don't know that it's coming down. It's certainly been a margin story, both this quarter and for most of 2023. So if you think about last year's results as we were clawing our way out of the earnings recession for the S&P 500, it was really a margin-driven story, and that continues to be the case. Now, if you look at forward expectations...
So margins are holding up?
Margins are holding up. Margins are improving significantly from those inflation-driven lows from 2022, and that's still the story now in 2024. But as you look at the forward expectations for revenues, those are still pretty solid and improving, and also, I would even note in the small cap space, the revenue expectations are improving for the next 4 quarters. So you've kind of even got these economically sensitive small caps, maybe going along with the GDP report, also showing stronger revenues over the next year. So while it is a margin story right now, revenues are expected to come online soon.
When do we start to see the promises of efficiencies of from AI actually starting to affect margins?
If he could answer that, he would be on his island in the South Pacific.
Because the investment has been so big from some companies out there right now. When do we start to see that investment pay off?
I think that's definitely a longer dated story, right? So we're talking years out. It's something that's not necessarily going to filter through 2Q. Obviously, it's spending on the revenue side for the companies that are having that allocated towards them. That'll help, but I think it's a longer dated story for AI to drive some of these efficiency gains.
I mean, so at this point, we just talked with our economic and rates team, and it feels like that soft landing seems to be in place. Is that safe to say that's what we're seeing from earnings so far, easily, or if not better?
It seems to be the way that we're definitely trending, right? So you've got the better GDP report, you've got CPI starting to come down, PPI also coming down. The Fed has a lot of leeway to do whatever they feel like they need to do, be it more rate cuts than consensus expected just a few months ago, or taper the balance sheet even less than they have been, right? So giving them a lot of leeway at the end of the day, and that certainly can help companies going forward.
Always nice to have some leeway. All right, going to leave it there. Hey, thank you so much, Michael Casper, Bloomberg Intelligence Equity Strategist.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We've talked throughout the day how economically sensitive shares such as financial and industrial companies have led gains today. Smaller firms extending this month's surge to almost 10%, largely outpacing the group of tech mega caps. And if you take a look at an equal weighted version of the S&P 500, where the likes of NVIDIA carry the same heft as Dollar Tree, just to give you an idea.
What a world.
Yep, beating the U.S. equity benchmark. So let's get back to the trade.
And the factors that really matter, like Fed policy and earnings. Back with us is Doug Ciocca, CEO and partner at Kavar Capital. They've got approximately $1.25 billion in assets under management. Doug joins us once again from Leawood, Kansas. Doug, what really matters when it comes to today's investment environment? Is it anything beyond the Fed and earnings?
Oh, I think so. And great to hear both your voices. And thank you for having me on. You think about what's been happening the last 2 weeks as it relates to earnings trends, right? Dominant sectors coming to life, tech earnings having a hard time fulfilling lofty expectations, consumer strength being stretched a bit, industrials and staples are beating and raising, and you combine that with expectations of lower rates, going back to the priority and importance of the Fed, and maybe most importantly, even or equally important, is a weaker dollar. And that's going to lead, I think, some of this rotation / pivot / shading into directions what kind of be commonly or mentioned, right? Smaller cap companies, like you just said on the lead in, international investments, and really reinforcing a balanced portfolio and how you're fortifying your bond portfolio.
So how much, I don't know, I'm curious what you're hearing, Doug, from clients, from investors, in this environment where I know for us in the media business, there's so much news coming at us in terms of certainly U.S. politics, but geopolitics continues as well. And it does feel like there's a fair amount of volatility in the trade, depending on the economic print of the day or maybe the Fed conversation. Although I feel like the Fed narrative is calming down and getting more kind of all on the same page. Are people looking to play it more safely at this point? Or if they've got new money to work, are they willing to take an opportunity when they see the NASDAQ 100 down more than 3%? What is it?
Yeah, that's a great point. Because look, if you think about what are markets, right? They're just a manifestation of the kind of collective wisdom and emotions of their participants, right? And or maybe now they're surrogate algo bots. But uncertainty is seeming right now to trump, and that's not an intended pun, uncertainty, right? Uncertainty is trumping certainty. And so you have this manic nature that's reflecting shifting sands and heavy decision points that investors are feeling in other aspects of their lives, right? To your point, Carol, where are we with the political perspective? Where are we with the geopolitical perspective? And are we really lining up with monetary policy perspective? I mean, for crying out loud, before last night, we didn't even know we could watch the NBA next year. So there's just a lot of things that are being.
All right, now it's getting serious. I know.
But seriously, you're right. But that you really think about this is the preeminent environment for dollar cost averaging, particularly into sectors and parts of the market that haven't been participating, right? That have been left behind with all the excitement about tech and AI. That's left a lot of gaps and opportunities to put money to work in a very progressive fashion where you can make this volatility your friend.
So, Doug, what does work? Where should people be dollar cost averaging right now? Small caps?
Certainly small caps, but also look at yesterday, right? Not to be super dismissive, but the S&P had gone 356 consecutive trade days without a 2% drop. Longest streak since 2007. So this Mag 7 index on Bloomberg is down yesterday 12% for the July 10th high, which we got that friendly reading of CPI. And you had four sectors that outperformed not only the whole market, were higher on the day: healthcare, energy, staples, and utilities. So these are going to be, right, potentially the catch-up trade. And I think it's fascinating that portfolio managers are obsessed with terming the current trading patterns as a pivot or a rotation. It's mean reversion, right? It's attended to a shift in underlying monetary policy. We didn't just go through 99, right? We were not on the precipice of some kind of a dot-com-like bubble and debacle. At some point, the breadth had to widen, and I think, Tim, that's what's taking place. And those four sectors as beacons yesterday, I think, were very representative of that fact.
So, it's interesting. I was just looking, and somebody else, I think, pointed this out on Bloomberg. The S&P 500 hit a record. It was only a few weeks ago, right? July 16th. We're down about 4% from that record. Markets go up, markets go down. I mean, do you feel that prior to this, or that even markets are still a bit elevated when it comes to valuations based on what we've seen so far, about 1/3 of the S&P 500 reporting?
Yeah, and the third that is reported have come a little shy of expectations, about 6.5% year over year, but maybe only 1 to 2% quarter over quarter. But I think, Carol, the market has been so good since October of last year. Sometimes it's easy to forget that up until that pivot point on October 28th, the S&P was in a 10-11% drawdown, the NASDAQ 12 or 13, right? So you had a little refreshing pause that was very beneficial. People talk about how awesome 2023 was, and somehow completely forget that 2022 was horrible, right, from every class of asset perspective. So I do think having some of these pullbacks in the S&P, 4 or 5%, if it gets a little deeper, that would make a lot of sense to us, just because you do want to stave off a more problematic air pocket into the future. So we kind of enjoy the volatility, again, from the standpoint of having these dollar cost averaging opportunities.
Yeah, we're still up 32% on the S&P 500 from that late October 2023 low.
Yeah, pretty remarkable in a relatively short period of time. All right, so you said that we have a hard time understanding where we're going to be watching NBA games in the near future. We don't know who's going to be in the White House come January of 2025. How is political risk weighing on the trade, or do you think political risk even matters?
So over long periods of time, Tim, empirically it doesn't. Right? Undeniably, every bit as important as the occupant of the Oval Office is going to be the lineup congressionally speaking. What would I think undermines the market any confidence that it's trying to transition through this election period would be if the election doesn't end. Right? We all went through on this call what was taking place back at the end of 2000 with the hanging chads of the Supreme Court decision in the last week of December. I think because there's such polarity across parties in the country, going back to kind of collective manifestation of the wisdom and emotions of investors, that would weigh heavily. And I think that level of uncertainty would likely cause people to maybe want to take a little bit less of an aggressive path with other aspects of their life, including investing. So to me, that would be kind of undermining to the market. Having a really nice follow through to the back half of the year would just be an inconclusive outcome on election day or election month.
Hey, Doug, just quickly, got about 30 seconds here. I mean, the past few weeks, as we kidded or have been kidding this hour, that has been chock full of political news, particularly about the U.S. presidential race. How many conversations are you having with clients and investors around this? And again, just got about 30 seconds.
Yeah, a lot, Carol. I mean, it comes up quite a bit. I think a big part of a job of a wealth advisor is to continue to reinforce objectives and not just say, hey, over the long term, we know things typically would end up being fine. But let's make sure we understand the consequences of activity that could be undermining to achieving our objectives. So it all kind of comes back to the context within a financial plan that we set up realistic objectives that'll couch the amount of risk we should be taking at any point in time anyway.
All right. Great stuff. Doug, as always, thank you so much. Doug Ciocca, CEO and partner at Kavar Capital, joining us on this Thursday.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Spending? I feel like I'm always spending money.
That's true.
I wouldn't say it's always discretionary.
When you've got two little critters.
Yeah.
Money goes out a lot.
Yeah.
When you have kids in general.
Easy come, easy go, as they say, right?
Well, listen, you're helping out the economy.
Yeah, okay. Speaking of helping out the economy, U.S. economic growth accelerated by more than forecast in the second quarter. It illustrates that demand is holding up under the weight of higher borrowing costs. Personal spending advanced 2.3%. That's also more than projected. We got those numbers this morning. So, Carol, there's certainly two measures of the economy that came in stronger than expected. Yet, how are people feeling?
It's an important question. I mean, you want to know what the sentiment is right now, right? Where are the stresses? These are things that Katie Thomas, lead at the Kearney Consumer Institute, tracks. She is back with us from Pittsburgh. Katie, good to be talking with you. I got to say, you guys do have out a new survey. You talk about global consumer stress. How stressed out are consumers at this point?
Yeah, so consumers are still stressed, but interestingly, we're starting to see little storylines peel apart, unsurprisingly. So, for instance, when we talk the global consumer, last cycle, 11 out of 12 countries moved in lockstep. So they all moved in the same direction. Whereas this cycle, we saw a split. So 7 got a little more stressed, 5 got a little less stressed. And so you're starting to see the specifics of exactly how, in particular, local politics, government politics, and conflict, and then, of course, the specifics of financials are impacting consumers. Sorry, go ahead.
Well, I was going to say, just when exactly did you do this survey, just so I have an understanding of the time frame?
We ran this survey about a month ago in June. For U.S. context, it was previous to even the debate. So as we think about politics, in some ways, I think it removes the noise of politics, the Trump assassination attempt, and the change over the weekend. But it was, that stuff is not factored in yet.
All right. So do you think, based on your results, do you feel like since the debate, since all of the U.S. political news, do you feel like anything has changed dramatically in your view?
Probably, we saw when we talked to consumers, 48% of American consumers said they were pessimistic about the country's political future, whereas about 28% said they were optimistic and the rest were just indifferent. And so I would guess we've seen those numbers switch around a little bit in the last month, but ultimately we still feel like the general theme on the consumer is the same, which is this feeling of resignation. So even though things are changing, there's still a lot of uncertainty. So we're seeing these persisting pressures with inflation, with interest rates, and then politics. Well, not, certainly things are changing, but there's a lot of uncertainty. And that's leading to this consumer that feels like they have no agency or ability to impact any of the things that are going on in their lives. They're just subject to all this strife. However, as you noted at the top of the show, that doesn't mean they're not spending. So the reaction to this resignation, uncertainty, and frustration is manifesting in all different ways. And some of those ways are at the mall and at the stores.
Well, how do you explain the difference in behavior in terms of, we've had people on the show that say, don't listen to what the consumer says, listen to what the consumer does. How do you explain the discrepancy there?
Right, because they're spending based on
exactly.
And it is a backward-looking report, but
they're still spending.
Yeah.
It is. There's a couple ways to look at that. One is exactly how we actually try to analyze the consumer. So we have 2 separate consumer measures. One is called sensitivity, which is just voiced stress. So that's your more traditional consumer sentiment. And the reality there is, frankly, people will always say they're stressed. And so that's exactly what we are trying to offset with our other metric, which is around this idea of flexibility and agency. It's when I start to feel like I'm losing control, that's actually a leading indicator. So we're starting to see a little bit of that. One of the measures in particular within that is job security. So it's not necessarily the raw employment numbers or labor market numbers, but it's do consumers personally feel like they have some sense of job security. So it's really trying to peel back some of those different layers to try to kind of assess that say-do gap that we see with consumers, pretty much across all topics.
How much of this can change? It's interesting. I feel like markets have gotten a bit more volatile. Economic data points can sometimes, whether we kind of seem to say that they're pointing towards a soft landing, it can depend on the day when we might get something that might kind of surprise us. This morning's GDP report. Having said that, in terms of consumer sentiment, how much can it swing, perhaps, from week to week, from month to month?
I think you're right that, frankly, with any consumer trends, they don't actually move in quite as dramatic of a fashion as we want to sometimes think they are. So think of any of the trends that you discuss over the course of your show, whether it's sustainability or health and wellness, all of that. They were slowly marching in a certain direction, but none of those things are happening overnight. And it's the same with consumers. So even when it comes to stress, one example of a recent election was in Mexico. And so the Mexican election had happened prior to us running the latest version of this survey. Now, we saw their geopolitical stress go down, but then stress in other areas go up. So you're almost seeing a shift in the pie rather than some massive reduction in stress. So I think the devil's going to be in the details, Carol. I think there are different stressors, but at a macro level, it's always going to be a little hard to see some big swings.
Which is why, Tim, you and I walk in every day. I'm stressed. It may be different. It may be that the train bothered us, or there's something, dealing with, I don't know, shopping, getting stuff for your family, or work stress. Like, it just moves around.
Then I get here and I'm so relaxed as we prepare for our 3-hour show.
Is it that Zen tea you have every
morning?
morning?
It's that Zen tea, among other things. Katie, at the end of the day, the idea with a lot of the work that you do at the Kearney Consumer Institute is to help companies reach consumers, no?
Yes.
So
absolutely.
So then what should companies be doing to reach consumers in the environment that you described?
Should they do what Chipotle is doing, offering you more meat and rice?
And taking the hit on the bottom line.
Exactly.
Right. Well, and that's actually a great example of what I was about to say, which is what we're really encouraging right now is clarity and consistency from brands in the most straightforward ways. So a lot of the areas we've seen frustration are around misleading or deceptive things some brands are doing, shrinkflation in particular. If you ever want to go down a rabbit hole, I encourage the shrinkflation subreddit, where people are pointing out, for those that don't know, it's when you keep a price the same, but you reduce the amount in a package. You see it with detergent, with ice cream, with all sorts of different categories. In some ways, you can get away with that to try to keep the price neutral. But I saw one example for, I think it was pierogies, where it went from 12 in a pack to 9. So if you're a family of 4, that immediately changes the math of what you're buying there. Similarly, with some of the summer sales around Prime Day and, across the board, you see actually slowly an uptick in prices, and then the discounts aren't really discounts. So it's that kind of behavior I'd be particularly watchful of is, with consumers trying not to pull a bait and switch. Just keep it simple, keep it straightforward, and try to really deliver on your core offering.
All right, 2 things. I want a pierogi index. I think that would be really kind of good. And I'm really kind of hungry right now. I would go for a few pierogies. Wouldn't you go for a few?
I love pierogies.
We're so easy today, aren't we?
I don't think I had a pierogi until I didn't have a pierogi until I moved to New York.
Was that your first one?
That was my first one.
Yummy, yummy.
I'm from Pittsburgh. You should come here. There's a whole Polish contingent. You can find a pierogi.
I actually heard there's a Pittsburgh pierogi festival.
Yes, there's a festival. It's our their mascot sort of for the Pittsburgh Pirates. There's a pierogi race. It's a whole thing.
There's no more Pittsburgh example that you could have given, Katie, than buying a pack of pierogies. So I appreciate that. Thank you.
Kielbasa? You do kielbasa too?
Yeah, it's all part of it.
I grew up on kielbasa. All right, gotta love that. Katie Thomas, like we said, we are super, super hungry, but good stuff. Check on the consumer, always important. We talk about how important it is to the economy. We certainly play it out in economic metrics, but good to get another take on it. Katie Thomas, she's lead at the Kearney Consumer Institute, joining us from the home of pierogies, Pittsburgh. Can we say that?
All right, yeah.
Yeah.
I'm driving in my car. I turn on the radio.
Yeah, how about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
You drive me crazy.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, folks, we have about 15 minutes left in today's trading session on this Thursday. Bouncing around, call it flat, basically on the S&P and the NASDAQ 100, about 0.6 of a percentage point higher on the Dow Jones Industrial Average. So let's drive to the close. With us is Kathy Entwistle. She is Managing Director at Morgan Stanley Private Wealth Management, joining us on this Thursday from Ridgewood, New Jersey. Kathy, nice to have you here on us. What's top of mind for you in this market environment?
Yeah, thanks, Carol. Thanks, Tim. Great to be here. Top of mind is always, the economy and perception and what people are thinking, because a lot of times individual investors really react emotionally to the markets and what's going on in the economy or in politics or whatever the, interesting topic of the moment is. But really what we want to do is take some of the emotion out of that so that bad decisions are not made during times like these.
How do you do that though? I mean, how do you, emotion isn't everything. Is it
just happens?
Yeah. I mean, is it just making sure that people don't open their statements, or they, I don't know. How do you do it?
It's conversations. I mean, I think back to, different time periods that we've had in the markets over the decades, like 2008, 2020, when we had the markets precipitously dropping and every day just going down further and further. And that's when you're literally on the phone from start to finish all day long with clients, just really trying to talk them through it to help them see a longer term view versus the day-to-day very scary moments that can occur and what you're seeing in your portfolio. So it's more about talking them off the ledge in a sense, like we don't want you to panic. We don't want you to look at this as like your portfolio's down significantly with the markets and it's never going to come back up again. Let's take this time to look at the long view and also see, since maybe at the moment everything is down, let's take a look and see what needs to come out of the portfolio and what we need to invest in. Because when the entire market is down, the good, bad, and the ugly, it's actually a great time to reposition a client's portfolio and just make it a little bit cleaner, a little bit more healthy for what's to come in the future. Sort of like, where's the puck going?
Kathy, what are the stats that really matter to you? And I think about, even Bill Dudley in his Bloomberg Opinion columnist, of course, former president of the New York Federal Reserve, writing yesterday and noting that he's got some concerns that maybe it's time for the Fed to cut rates. He's been on the higher for longer camp. But one of his concerns, he said, wealthy individuals are still spending. That's not the problem. It's other folks who maybe have gone through all of their, maybe money they got during the pandemic or any of their savings, and that's the problem. You deal with higher income individuals. I am curious what metrics you follow so that you can properly manage their money. And does something like what's happening maybe on Main Street, is it as important to your world when you're managing their money?
Yeah, absolutely. So clearly the middle economy is struggling, and that is important because it does affect the markets and companies and profits. So the things that I think about basically are, how do we help clients align their priorities when it comes to goals and values and what their resources are versus what they want to do. So it doesn't matter if you have $1 million, if you have $100,000, if you have $10,000, or if you have $100 million. If you are spending more money than you have, or if you're not being thoughtful and having the right mindset when it comes to the allocation of your portfolio and what your time frame is, you're going to fail, right? You want to make sure that the resources that you have are matched up to what you're spending and what your goals are, and that you can align your portfolio with the right allocation so that over long periods of time, you don't have to worry about outliving your money or spending too much or having anxiety going on.
Speaking of allocation, interestingly enough, you guys are actually underweight on equities and overweight when it comes to fixed income.
True.
Explain the strategy there.
Well, the strategy there is that we've had a run up in the markets. We have, sort of estimated values of companies. Evaluations are very high. So it's like when you go shopping and you see this dress that you love, it's like, okay, it's $100 today, and that's great. But when it's $50 and it's the same dress, it's better to buy it at $50, right? So it's the same with company stocks, with things like that. You want to buy things at a lower price and be thoughtful about how you add to your portfolio. So there are areas of the stock market where we think there are still opportunities to get some good value. And those would be areas like small stocks or international, global. The US markets are just overpriced right now. And clearly we have, the Magnificent Seven that's caused a lot of that, but there's other companies overpriced too. So it's a matter of finding like very good valuations and going there. So we're not saying don't go all out, but just maybe go, be careful where you select.
Hey, Kathy, thank you so much. Really appreciate it. Kathy Entwistle, Managing Director at Morgan Stanley Private Wealth Management, joining us from Ridgewood, New Jersey. Folks, just got about 10 minutes left in today's trading session. Call it little change, basically unchanged on the S&P and the NASDAQ. More to come.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.